All right, it looks like we're live. As usual, I'm a little earlier than the scheduled time. If you listening to this recorded, jump 10 minutes forward, because right now I'm just talking to the viewers. A lot of you already waiting. There's Rudy. He's right right behind me. He is in his little bed. Clive should be coming on soon. So we've got Jonathan Wilson, we got Hannah, Blank Stairs, Indy, Dennis Gagne. Why do people not discuss the U.S. unfunded liabilities on the U.S. debt clock? Oh yeah, I mean, that's another problem that's coming up. I think in the next 10 years is going to get worse, especially with Clive can talk about that. He follows a lot the U.S. finances, so we'll touch upon that. Indy is here. Dennis Goya, Pablo Pina. Hi, Pablo. Denny Youngblood. Kuz Mario Saicedo. Silver is inevitable. Currency swap derivatives are probably the biggest threat, like chaos. Yeah, that's the title of the live stream today, is about the liquidity in the Treasury market. And that's a problem that's been around since 2014, actually. And we're going to talk about why it's happening and what it means, really, liquidity. Quadman 72 says, hi, Rudy and Clive. Yeah, Clive hasn't joined us yet. He will join us. And Rumpelstiltskin, hi, nice to see you. He's going to bid on Mario Bucks. That's funny. Oh, there's Rudy. He's just come out of his little bed. Maybe PBR dividend will get increased considering the oil price running up. It could. Juliette Goudreau from Acadie in Canadistan. aka Canada, yeah. Arcadia. Well, a lot of the French settlers, they went down to Louisiana as well, didn't they, in Acadia? And I think the word Cajun comes from Acadia. Don't tread on me, says I'm looking good. Oh, thank you. Mario, my eyes coming along okay. Yeah, I have to wait a couple of weeks to play golf still. But I'm going next Friday. I go every Friday for about a month to go and get it checked at the clinic. And I went last Friday and it's fine. Eric Bartone says excited about a live show with Clive. Yeah, I haven't had him on for a while. I enjoy Clive on the show. How do I get a job offer for the Clinton Foundation? Well, go onto their website and apply. Yeah. Manic Miner, good evening. Manic Echo. Hi, Echo. Nice to see you. Wet Southeast Wales. Yeah, it's not wet here. It's cooler and windy and cloudy. Gianfranco Bergagna is here. Hi, Gianfranco. Chezzy Mababi 96. Do you think a credit freeze is possible this year? Will central bank allow? Yeah, I think they won't allow a freeze. They'll just do some program like the Fed did in March, the BTFP. They still have. You notice that a lot of central banks now are stopping the rate hikes, and I think it's way too early. Well, and the problem is that they left rates too low for too long, and 4 or 5% rates are killing things, so the economy, so they have to stop. But I think we're gonna get more and more inflation. Andy, thank you for the super chat. Says the review with Susan Bradford made me sad. Yeah, I mean, Susan contacted me about 2 months ago, and she sent me the PDF a copy of the book and I read it, and it is sad and actually depressing to see all how the whole system is just really not fit, is all corrupt, really. Can you really trust anyone? Well, Clive is here. Let's admit him to the live stream. Pound going down on Friday. Yeah, the pound has turned around. I mean, the trend is lower versus the dollar and gold as well, especially. Hi, Clive.
Hello.
Nice to see you. How are you doing? Can you hear me?
Hello, Mario. I can hear you loud and clear.
Oh, good, good, good. I like your screensaver there behind you.
Oh, that's a picture of Lauterbrunnen in Switzerland.
Yeah.
It's a mountain village.
Yeah, nice. So I'm just like saying hello to everyone. We've got a super chat. Someone read a book that I interviewed the author, Susan Bradford. It was a bit like about this political situation in the US, and she goes on about how both sides of the aisle are like, it's all like kind of how can I say, a swamp. So anyway, Circun Actas says, Mario, Greg Menarino has been talking about saturation in the debt market and how it will cause everything to stop. Yeah, that's what the title of the live stream is, Clive, the liquidity in the Treasury market. Have you got any opinion on that? And after you talk a little bit about it, I'll give my 2 cents.
Well, I think we see that liquidity is drying up to some extent. The US Treasury yields at the 10-year yield is at the highest level in 16 years. And the reason it's going higher is because there aren't enough buyers to buy it at the old rate. So if you think back about a year ago, we had 3.5% interest rates on the 10-year yield, and a lot of people thought that was a good deal. I know you, Mario, said rates are going higher, so you're absolutely right. They are now 4.3%. So the rates continue to drive higher and higher. I think China has dropped out of the market as a buyer of US Treasuries, Japan too. So what's left is the public at large. The Federal Reserve's not there buying it at the moment. And the public at large want a higher interest rate before they put more money into the treasuries. So there is a bit of a shortage of buying in the market.
Yeah, and they had this liquidity. Basically, I'm gonna try to tell the viewers what it is, because I actually worked when I started out in London in '92. I came from the private bank in Switzerland where I dealt a lot of bonds, but just for clients. And then I started working at Cantor Fitzgerald, actually, which is the biggest treasury broker in the world at the time, and probably still is. So liquidity is when a client calls the dealer and says, what's your price for these bonds? And it's like calling someone to buy gold, what's the price? But usually treasuries, they're as you can see here, it's now it's a 25, I think. It's almost a 25 trillion market. Treasuries are supposed to be the safest and most liquid, which means if I call a broker, he'll make a bid and offer very tight with a lot of size. But ever since 2014, they've had problems with liquidity, and they had huge problems in 2020 during the March. It says here, look, the market for US debt is considered the safest in the world, in part because of the ease which traders can buy and sell bonds. That liquidity, however, has deteriorated in recent years as banks have pulled back from their traditional market-making roles. Bloomberg index measuring treasury liquidity hit its worst level in late 2022 since the market shock of 2020. So what's going on? Why are the banks not making market as much? Well, because they have these capital rules, the liquidity ratio, SLR. And here we go. SLR has always been a puzzler for a year. So I think the Fed, they impose here this is what it says. So it's governments interfering and then trying to solve a problem from the old crisis, and it creates a new crisis. After spectacular collapse of the banking system during 2008 crisis, regulators demand lenders hold more cash on hand to boost equity capital. The SLR requires large banks to have capital equal to at least 3% of their assets, 5% for the largest systemically important institutions. So that's one of the reasons, I think. And the Fed, though, they suspended this rule during the 2020 crisis for about a year, I think, and then it dropped it back. And the other reason, Clive, I think liquidity is drying up is because the Fed is the biggest market, biggest buyer, have been the biggest buyer since 2008 and 9. And they've just basically made the market so much bigger. And if the banks can't, participate as much because of capital requirements, there's going to be very little liquidity in there. And I've also seen that the U.S. Treasury, they want to buy back some of the old bonds because there are bonds that are called, let's say, the 2-year notes will not be the 2-year note all the time, because after a year will be a 1 year. So they have what they call on the run 2 years, 5 years, 7 years, 10, and it changes. And the old bonds and notes, they become a lot less liquid. And I can imagine it's pretty bad right now. And with all the derivatives there as well in the bond market, it's a recipe for disaster, I would say.
I think the real problem is the Fed also has stepped out of the market. The Fed is allowing its bonds to run off. I forget the figure now. I think it's 100 billion a month or something like that. Maybe I got the number wrong, but they're allowing a certain amount of their bonds to mature and only reinvesting part of the maturing bonds. So they're not really in the market buying and selling bonds every day as they were for the last decade. Now, at some point, they're going to pivot and they'll start doing that again. But right now, the Fed is not there as a buyer.
Yeah, and I'll show the viewers what Clive means here as the Fed's balance sheet. They are actually letting it go off. So let's go like this. Yeah, this was the top here. They had almost 9 trillion. And then here, what happened here? Well, that was back in March when you had the regional banks fail. They went in and reversed all their QE, and now they've gone back to doing so. They're now down to just over 8 trillion. So they've gotten rid of almost 1 trillion, which, like you said, makes a difference. And the fact that countries like not just because of geopolitics, but like Japan, they're getting rid of some of their treasuries in order to try to defend the yen, right?
Yeah. I mean, I think the Treasury market's got a problem. As Jamie Dimon said the other day, to fund the budget deficit going forward, they're going to need to spend or borrow 2 trillion a year. The Treasury will have to borrow 2 billion a year. They're going to have about 5 trillion a year maturing, which has to be replaced at higher interest rates because that was previously borrowed at low interest rates. So when it matures, they have to reinvest at today's interest rates, which are going to be 5% instead of 2%. And then you've got the Federal Reserve letting its bonds go at the moment. I don't know the figure, but it's probably several hundred billion going every year into the market. So there's a lot of supply of Treasury bonds going to the market, and the buyers there aren't as many buyers as there used to be. And of course, with more bonds, there's a lot more choice. And as you said, some of these bonds are becoming a little bit illiquid because they're issuing new bonds which are much more liquid, and the old ones kind of get left behind a little bit stale.
Yeah, thanks for the super chat. Oh, I just realized the name of this channel is Cuz Mario Said So. Thank you, Cuz Mario Said So. I just got that name actually. Says to help Rudy fight inflation. Clive, I just wanted to show you and the viewers more for the US viewers because it's not available yet. overseas. But this might, I don't know if this might interest you, but this is for people who are concerned about their valuables being safe. I've got I've hooked up with the guy who has created the Dirty Man Safe, and I highly recommend you have a look if you're worried about, hiding your valuables. You can watch the video if you go on their website, and I've got links below in the description. And if you use the code Monaco 10, you get 10% off. So there you go, Dirty Man Safe. So yeah, just wanted to show you guys that. Yeah, it's not, he sent me one here in the UK, but he's not selling it here in the UK yet. So yeah, have a look in the description for the Dirty Man Safe.
So for those who are buying safes and haven't bought one yet, you can generally find that at the back of the safe and the bottom of the safe, there's some holes which allow you to screw them into the wall or screw them into the floor from the inside, which means someone can't get them out unless they can get inside to start with.
Yeah, this one is supposed to be, you're supposed to dig it outside somewhere, and it stays there, and it has like a little wire that once you dig it out, you can pull it. It's quite interesting. I've got one. I haven't really dug my garden. The individual that likes digging is right behind me there, Rudy. He dug a really deep hole the other day on the flower bed, but he's going off digging now. So Clive, the other thing I wanted to show you, and I think you'll be interested in this, and also the viewers, just to show how far the pound has gone down. And I know all the other currencies are going down as well, but I was looking at this, and so this is the pound versus the Swiss franc going back to 1960. And what I saw here is that for £1, you used to be able to get more than 12 francs, which is quite amazing. And we're almost down to 1-to-1 now. I think it's around 110. And what I did a little experiment. So I'm gonna stop sharing that, and I'll show you live. I've got 12 francs here from pre-68. They're all silver. So, and I got an old £1 note. But I think this is from the 70s, but let's pretend it was from 1960. So in 1960, with one of those, you could get 12 of these.
And they were made of silver.
Yeah. And now I've got a pound, and I can only get a franc and 10 centimes. So that's how far the pound's gone versus the Swiss franc. And I also, when I came to live here, I remember really well because I had to negotiate my salary because I was working in Switzerland. They had to, pay me at least how much I was earning in Switzerland, and I used the rate of £2.80. So I could get 280 when I moved here, and now it's 110, which is. So I was just wondering, do you remember where the Swiss franc was when you moved from the UK?
I believe it was about 280. It would have been 80. It would have been 1985 when I arrived here in Switzerland. You probably got it on your chart.
Yeah.
Just on your silver coins there, Mario. You said they're worth £12 now. Well, in fact, of course, they're made of silver. So they are about £3 each. So you got £36 for your £1 investment back in 1968.
Yeah, I mean, these are all Swiss francs, 12 Swiss francs. Yeah. So, and the other thing I've got, people might be interested, is these here, Hong Kong dollars.
Lovely.
Yeah, I think it's about just over $1. I don't know if they're still accepted, these notes. They're from actually Hong Kong Shanghai Banking Corporation, which is interesting.
It looks a bit old. I don't know. I don't think it's.
Yeah,
I think it's an old one.
1981. So yeah, it's probably not accepted anymore. So let's have a look at some questions, Clive. I know you have your opinion on Kinesis money recently. Mario, just wondering if Clive do you know anything about Kinesis money?
No, never heard of that one, Maria. Is that a cryptocurrency or what?
Well, I think, no, they're like a place where they store gold for you, and I'm not sure about silver, but they also have a cryptocurrency. The thing about Kinesis money is that they pay you some kind of interest on your gold, even though they don't lend it. And to me, that always put me off, because that means where they getting that money from? It must be from the new customers. So
It makes no sense when you get an interest rate from someone who's not lending it out.
yeah, I'm
I mean,
not sure they call it an interest rate, but they do give you some return on your gold. And that just puts me off. I'd rather store it somewhere and get charged every year and know that it's safe and it's there than get some interest, because it means that they're lending it. But yeah, so Clive hasn't heard about it. When you're going to do another video on derivatives and how much institutions like Wells Fargo's, JP Morgan have on the books. Well, I can tell you, I mean, I think JP Morgan has about 60 trillion, somewhere in the 50 trillion. Wells Fargo, they're not one of the biggest derivatives dealers. It's mostly JP Morgan, Citi, Bank of America, and Goldman Sachs, right, Clive?
Yeah, and the real trouble with derivatives is when something moves, a price of something moves a large amount, there's always going to be someone at the wrong end of that derivative. And whilst banks are matched in their book, so they'll be long and short the same thing at the same time, but they'll be, for the long side, they'll have one counterparty, and for the short side, they'll have a different counterparty. If any of those counterparties in the system fail, then the whole system could go kaput, because they will fail, and the numbers are pretty stupendous relative to the size of the rest of the bank's books. So it's a dodgy situation to have so much derivatives out there.
Yeah, the Office of Controller of the Currency, OCC, you can go on their website. They've got all the data for the banks in the US, but I suspect there's a lot more. There's a lot more derivatives out there than they say, because the BIS changed the way they accounted for it after the 08 crisis. And what you said there about derivatives as well, and I'm almost finished with this book. Have you finished it yet or not, Clive?
No, I haven't started it.
Yeah, but there's a page here, and I marked it with one of my Hong Kong dollars, and it talks about duration risk, and then it talks about liquidity risk, and it talks exactly about what we've been saying about the derivatives, that it's crazy. And they're even saying with the derivatives risk that Goldman Sachs calculated some years ago, before they started raising rates, that every 0.5% hike in rates would affect the derivatives exposure of all the financial system by $1 trillion in losses. So we've had rates go up like 5%. I'm sure they're trying to keep things together. And I think the BIS, I made a video earlier last week, about the BIS warned about this derivatives problem in Treasuries, the basis trade. So I think it's like, could be hanging by a thread, but we never know what's going on.
For sure, there's some big institution which is at the wrong end of this. I don't know who it is, no idea, but time will tell. And if we get another couple of hikes in interest rates, maybe even without that, because don't forget, we're going to have the third quarter numbers coming in from the banks in a few weeks.
Yeah.
But sooner or later, something's going to break with one of the big institutions, which will be at the wrong end of this.
Yeah, I think that's the FDIC data. I think it comes out in the beginning of November. It's usually a month and a week after the end of the quarter. And that's why I think the Fed is paused their rate hikes, even though and then they were still a bit hawkish going forward. So I think they're really between a rock and a hard place here. Mr. Shovel, 1968, thank you for your super chat. All the best from Denmark. Keep stacking. Yeah, Denmark, that's a nice country. I think I was there many when I was a little boy. I went to the Tivoli Park. Have you been to Denmark?
Yeah, I've been to the Tivoli Park many years ago.
I think I was 5 years old.
Mm.
Frank Kavija, thank you for your super chat. Exeter's pyramid will come into play. Oh yeah, that everything will rush down to we know what, don't we, Clive? Down to gold and silver.
Yeah, I mean,
Heard of
I think so.
Exeter's pyramid?
Yeah, that's I've seen that that pyramid. It's
Yeah,
obviously gold and silver is at the base, or
yeah.
is it the base or the peak is the base of the pyramid, isn't it?
Do you remember these? I guess this is 10 bob, isn't it? 10 shillings.
10 shillings, 50p. Yes, I do indeed.
Yeah. Yeah.
A
It
lovely
does-
specimen
funny.
there. That's
The old notes don't say the year they're from. It's weird.
looks like that one looks like new.
Yeah, it is, but it's
Doesn't
from the 60s, isn't it? It was still pre-1971, I guess.
Yeah. I remember back in when I was about 6 or 5 years old, my granddad, to amuse his friends, put in front of me a £1 note and a bar of chocolate, which at the time cost sixpence, and asked me which one I'd take. And I took the bar of chocolate, and then all his friends laughed because I should have taken the £1 note, because you could have bought with at sixpence, you could have bought 40 bars of chocolate.
Now I think I don't usually have much chocolate, but I felt like having one the other day. I think it was 89p for one bar.
Yes, and about a year later, he tried to play the same trick on me with a bar of chocolate, a £1 note, and a gold sovereign. And I know I must have been about 6.5 or 7 by then, so I'd wised up and I took the £1 note. Now his friends had no clue what a sovereign was. My granddad worked for HMRC, so he understood these things. And he tried to explain something about Gresham's law, and that the sovereign, even though it was only £1, was actually worth more than £1 because it was made of gold.
Yeah.
And I should have taken the sovereign.
Because Mario said so, thank you for your super chat. Thoughts on if government shutdown will affect mortgage payments, student loan repayment? I guess just not paying people can finally cool the labor market. Have you got an opinion on that, Clive?
Well, first of all, if they shut down the government in a week's time, it does mean that several million employees will be spending less in the shops, which is bad for the economy. And but you'll still have to pay your student loans and your other debts. That's not going to go away. And the government, whilst they're going to furlough their employees, those who are regarded as essential services will have to go to work without pay. That's what they're saying. So I'm quite sure collecting the student loans will be regarded as an essential service. So yeah, they're going to have to pay it.
Yeah, and student loans are now is it from October that you have to repay it? Yeah. Just wanted to show, I don't know if you saw that video I made about this book, Clive, The Great Taking.
I didn't know.
Yeah, but I read the book on PDF. So it's thegreattaking.com. I recommend everyone, I recommend you read it too, Clive. It's a bit scary, but it's important to read, I think. And I thought it was such a good book that I had to buy the physical
hardback. Yes.
Have. So
Always good to have the hardback.
Yeah, because online you never know what will happen. And Clive, maybe we can talk about your Millionaire's portfolio asset allocation. Do you want to show? I mean, this
Sure,
is
I'll put that
millionaires, but it could help anyone, right? You don't have to be a millionaire to.
Sure. So let me put that up when I figure out how to do it.
Let me allow you to share it. Hold on. All right, go ahead.
Right. Share. So I hope, can you see it now, Mario?
Yeah, yeah, we can see.
Okay, so I just put together, I've been doing wealth management for 47 years before I retired,
Yeah,
and I carry on talking to people about their wealth today. So I put together what I thought would be a starting point for discussion with a typical millionaire that I've been dealing with in my career as to how I think he could allocate his assets at the moment with everything we know about the environment. And what I think will interest your viewers on this is the first column has the asset allocation, of which you'll see global equities at 60% is my largest investment. And then you'll see the second column is called extended financial forecast return above inflation, where I put in my estimate, and this is a personal figure, of how much I think these assets are going to perform over an extended period over and above inflation. So you can see the biggest investment I'm talking about is equities. I think they're going to give about 4% higher than inflation. And if we just sort of run through the list of assets that you see here, obviously wealthy people will have heirlooms, have works of art, antiques, collectibles, and other rare and desirable items. Can't do anything about that, so I'm not included that in the percentages. It'll be what it is. But I think my message to anybody who's got a very large percentage in illiquid investments is you probably want to have a little bit of a plan to make some of those liquid, like put some things into auction or find ways to unload them. Cash, I don't like cash deposits or money market. You've got to have it because you've got to pay the bills, you've got to be prepared for emergencies, and there might be some great opportunities around. So I'm putting that at 8%, but you won't make any money. I've put the expected return above inflation at 0%. And that's before tax. After tax, you're making negative returns. And short-dated bonds, I put at 4%. I did actually see someone in your chat
actually,
was asking.
Clive, for cash, the return with inflation would be even negative, wouldn't it? Even before it, because it's losing its purchasing power.
Correct. I'm assuming that the interest rate on cash will rise a little bit more.
Oh, right.
I don't think we're done with the. This is a looking forward, and I don't think we're done with the interest rate hikes.
Yeah. Because, like here, for example, in NatWest account, I get like 1.75, and we got CPI at 6.7. So I know you can put it in NISA maybe at 5 or 6, but I need that cash quite readily, so that's why I've left it there.
And I put a little bit in short-dated bonds.
Yeah.
Again, you're not going to make any money on them, but it's a parking place to diversify away from the banks. Long-dated bonds, I would not hold any at all. I think you're going to lose money on them for sure.
So I guess you've gone from being like, there's a lot of fund managers who's still holding a lot of bonds, like 60 equity and 35 or even 35 bonds. I think bonds are a bad place as well.
They are the bag holders. I can tell you the clients of those managers are really questioning what they're doing with their bond funds in the discretionary portfolio. Typically, they've had the bond funds for 5 or 10 or longer, and it doesn't really matter how long that fund has been in the portfolio. Even allowing for the interest payments they've received, they're in negative territory at the moment. And I think it's just a question of time before people say, I'm done with bonds and I'm out of here. So especially long-dated bonds, you're going to lose money. That's my opinion. And we've got to drift out of them. And I think we could get a rush for the exit at some point. Customized investments, I don't really like them, but there are some interesting things out there. So I put 4%. So you're not absolutely at 0 in that arena. Hedge funds, again, I'd say there's a huge survivorship bias in terms of the performance of hedge funds when you see the official indices. So you could be misled into thinking that hedge funds are a good bet. But if you strip out all those hedge funds which went out of business, well, they have been stripped out, if they were put back in again, you'd find the performance of the hedge fund industry has been fairly mundane. I think you can have some because it does, if you have the right ones, it does tend to perform differently from the major asset classes. Real estate has always done well over long periods of time. I realize there's a big problem at the moment with commercial real estate, but if you buy right, you'll be okay. Equities, I have a high percentage there of 60%. And the reason I like that is companies are run by very intelligent boards of directors. They're highly paid. They have share options. They have incentives to make the company bigger. And of course, companies generally pay dividends, which is what I eat. And I think that companies and the equity market has proven over countless decades, even if not centuries, that it can navigate the woes of the world. It can, we've had wars, we've had pandemics, we've had all kinds of things, and equity markets continue to hit all-time highs. So I think equities are there, and I don't think, honestly said, I do not think they're very overvalued. They're a little overvalued, but not by historical terms. We've had historical periods of decades where they've been much higher valuations than we see at the moment. So I'm not unhappy about equities. Real estate investment trusts, I'm quite happy to have that in my portfolio. Tangible assets, which if you buy the right ones, you're going to see yourself all right, and you'll collect probably a 3% dividend. Gold, I do like. I think that could be an extremely good asset in the environment we're going into, which is one where the government finances are starting to become very problematical. And that's why I've put down one of the higher returns for gold and silver of 8% above inflation. I'm only allocating 6% to it, but that's a significant increase from where 6% to gold and 6% to silver. That's a significant increase from where asset allocators have traditionally been, which was typically under 5% for the two. And I'm talking about 12 here. And I think, realistically speaking, as people start to lose trust in the mainstream currencies, gold and silver in the coming years will do very well. I also put down, as a little bit of a flyer, Bitcoin, Ethereum, and crypto. And I know some people are going to have a real debate about that one, but the allocation is only 2%. So the portfolio I designed, if my figures work out, should produce 4% a year. But if that Bitcoin and Ethereum and crypto all goes to zero,
4% over
inflation.
Yeah,
4%.
So let's say it's at 4% in the US CPI, you'd get 8.16.
Yeah, something like that. Now, on the debate on Bitcoin, which people are going to take me to task on that one, if Bitcoin does go to zero, which is a possibility, it'll probably take 10 years, you lose 0.2% a year. My portfolio is producing 4.16 over inflation. Well, it'll only be 4% over inflation. So I don't see it a bad idea to add that little bit of a flyer. And of course, if some of the pundits are right with their forecasts of where the Bitcoin price is going to go, and you can look them up, but the forecasts are sometimes quite extreme to the upside, it'll add a nice boost to your portfolio.
Would you keep the same weightings for if you had, let's say, only $10,000 to invest, or would you switch it? Focus more on gold and silver, be riskier? Because this is more for someone, I guess, who's worked all his or her life and wants to maintain that that wealth. But if you are a bit younger and you just starting out, I guess you'd recommend something different. Or
historically, people with only $10,000 didn't have access to this type of asset allocation, but things are changing now with online brokerage accounts and so forth. So many people, when they make the effort, can access, if they wish to do so, most of the things on this portfolio, and in small size. Obviously, if you only have $10,000, I think you've got to be thinking about other things, such as having more money in the bank to cope with, as a percentage, to cope with unforeseen circumstances, like illnesses or losing your job. And probably it's tough to get proper diversification in the equity market. Of course, you can buy an ETF, and the ETFs, but just for your users who don't know what an ETF is, an ETF is an exchange traded fund, which is a very low cost way of getting into hundreds of shares with one investment. So an ETF is a way where the retail investor, for a small amount, $1,000 or $5,000, can buy shares in the ETF and be exposed to the entire S&P 500 or the entire FTSE 100 or the World Equity Index. So for those who don't have a lot of money and can't therefore spread it around individual shares, certainly ETFs are the way to go.
All right.
But yeah, would I do the same thing if you had $10,000? No, I don't think so. I think I'd be dropping a lot of the things on that list and perhaps focus on cash, gold, and an ETF, and that would be it.
Okay. So just to let the viewers know, this is not Clive telling you what to do. This is what he would tell one of his clients, or that's what he's looking at. You should do your own due diligence. But I think what it shows is that, yeah, sometimes it's good to spread your risk around. I personally, I'm not too sure. Yeah, I mean, the 60% equities, if you look through since the early 80s, equities have done well if you've held them long term. But there was a period, Clive, from 1929, I think, to 1952, where they went sideways, wasn't there? I mean, about
absolutely. I mean, some people will say to me, this portfolio is way too risky. It's going to be hugely volatile. You're going to have sleepless nights, and that's absolutely right for those people. And there's other people going to say this is much too conservative. You've got far too much in fiat limit related assets where the government debt is in very dire straits, and really you need to juice it up and borrow money and have a much higher exposure to all the tangible assets, from gold through to Bitcoin, through to equities, through to property. So this is really just a talking point as to where I'd be talking with a typical client who's been around the block and understands the world.
All right, no problem.
Let's stop the share on that one.
Yeah, let's see if we've got any questions here. 15-minute flying cities. Yeah, guys, if you have any questions about what Clive was speaking, feel free to ask.
I just mentioned a couple of inflationary things we've seen this week. We've got the United Auto Workers demanding a 40% pay rise in the United States. And the oil price may have gone unnoticed by people who aren't watching this, but it's moved well above $90. It's about $93 now. And so those two things, it's not the UAW which is going to raise the rate of inflation, but if they win their claim for 40% pay rise, it's going to set a lot of expectations for workers everywhere who are all going to be asking for pay rises. So I think that's an inflationary element which is coming in down the line. And the last thing to note is that for lots of reasons, the cost of housing is going up. Now, house prices are going down, but your mortgage payments are going up, and those who've got houses which are rented out are paying, in many countries, are paying more on their mortgage and are starting to put up the rents as well. So we've got inflation coming at us from several sources, and I don't think that the government is going to achieve its target of 2% inflation. Which means that when Powell says higher rates for longer, I think he's probably telling us what will really happen. We're going to have higher rates, and it's going to last longer than people think.
Yeah, and here in the UK as well, they've had to raise the pensions and the benefits by almost 8% because of this triple lock. And you know, we have a growing elderly pension population, and they don't work, and they're going to be spending more, and there's going to be less people working. That's going to put pressure on prices. Someone's asking here, what happens when the banks and governments collapse? What will happen to people's Social Security or their welfare benefits? What happens to programs like Medicaid and Medicare? Do you want to answer that first, and then I'll try to answer it?
So first of all, these programs are not fully funded. They are destined to run out of money at various points in the future. For example, the largest US pension fund, which I think is called something like the Civil Servants Retirement and Disability Fund or something like that, I think it's about 2032 or 33 when it runs out of money. That does mean that the government, either they'll have to reduce the benefits, which would be illegal, or the government's going to have to step in and fund those payments, which would, according to present estimates, is going to cost the government $500 billion a year on that one alone.
Clive, oh, sorry, go ahead.
Yeah, I was just going to say that I think there's another one which runs out in a few years. Maybe it's 2027. It's the Transport Workers Pension Fund, which is a government pension fund.
Yeah, and you know, I read quite a bit today, this book here, and he talks about the fact that with the policy of very low interest rates we had from like even since the dot-com bubble burst, because don't forget Greenspan, he took rates down to like 1% at one point. They raised it back, and then after the '08 crisis they took it down to 0 up until recently. What he is saying in this book is that it's not just the government that's having problem funding all its liabilities, but also public pensions and private pensions, because you know, they're not getting as much return, and they've promised people, you know, 8%. So they have to leverage, and it creates a problem. A lot of the pension funds, corporate and private funds, they have trillions in like a mismatch. So their assets haven't kept up with their liabilities. And just want to ask you, Clive, someone asked about the unfunded liabilities here, which is up to almost 200 trillion. And that's, I guess, what the government has promised to pay people. Isn't this one also going to be in trouble in about 10 years?
The government's going to be in trouble long before we get to 10 years.
Yeah.
The reason for that, can I put up another little chart for you, Mario? If I can share one, which will demonstrate that.
Okay.
Let me just go to there and share that. This is the government's own plan from the Congressional Budget Office of the level of debt as a percentage of GDP. And you can see that it's set to, according to their own numbers, to keep rising and rising to be beyond record levels. Obviously, this is looking fairly unsustainable on their own numbers, but it's actually going to be a lot worse than what you see here. First of all, the government has got a long track record of overspending and collecting less in taxes than is contained in their budget. For example, I looked at just over the last 12 months or so, how their budget deficit forecast had changed. So back in May, they thought the deficit for 2023 would be 984 billion. By February, they changed it to 1.4 trillion. And it looks like it's going to end up at 1.5 trillion. And I would just like to say that's with the benefit of them writing back a negative expense in August of some 330 billion related to student loans. What that figure negative expense was, basically when they forgave the student loans a few years ago, they put that down as an expense. Well, now the student loans have to be paid, so they're putting it as a negative expense. So the reality is, this year the deficit was originally forecasted about 900 billion, and it's actually, realistically speaking, about 1.9 trillion.
Yeah,
that's how much they missed it this year. And they forecast that the interest on the national debt would be 475 billion for this year. It's actually coming in at 644 billion.
yeah.
So next year, that interest figure is going to be much higher. And the reason it's going to be much higher is because the maturing debt of the government is maturing at 2%, but they're going to have to refresh that debt at 3, 4, 5, 6%. Currently, the 10-year rate is 4.4. And this is a chart, again, from the Congressional Budget Office. It's their own chart, not mine, showing if you look at the purple line at the top, that's where they see the deficit as a percentage of GDP. Well, we all know that figure is going to be too conservative. But the other figure, which you see, the blue line underneath, is the impact of the interest outlays, which just grow and grow and
Yeah.
grow over the
That's
years.
probably underestimated as well.
It will be. I mean, I've done my maths, and of course, it's a little bit back of an envelope, but it is possible that by 2033, the interest on the national debt might exceed the revenues that they're collecting in taxes. Now, there's a few assumptions go into that. One is that they have a miss in their expenditure. They overspend by the same extent as they overspent over the last decade. And the second assumption is that interest rates move up to 9%. But at 9%, and with the same kind of miss as they had in the past, by 2033, we will be at a paying interest on the national, or the US government will be paying interest on the national debt
by borrowing
their forecast tax revenues.
So they have to borrow to pay the interest.
Well, we're not. Yeah, if we were to go in that direction, we're not going to get there. It's impossible. It's mathematically impossible because the money isn't there to lend to the government.
Yeah.
So something bad.
Yeah, and the other thing is,
in that direction will happen before we get there.
This forecast doesn't account for wars, financial crises, pandemics, or anything, right? So
exactly no natural disasters, no banking crisis, no recession. I mean, no black swan events. I mean, we know there's going to be a recession. We know there's going to be a natural disaster. We know there's going to be something going on in the world in the next 10 years. We've never gone through a 10-year period without countless things happening. Yeah. And every time something happens, you have this need for the government to spend their way out of the problem to keep the population happy. So that's bound to happen. So the figures will prove to be too conservative. But according to the Congressional Budget Office, they have no choice. They cannot account for contingencies like that because by law, they've got to go with the official budget of the United States. And not only that, they have to assume under the law that these bankrupt pension funds, which will be the liability of the government, won't go bankrupt and that they will still pay money which they don't have.
Yeah, I mean,
that's in their own, that's on their own website. So realistically speaking, these numbers are definitely going to be too conservative.
So I'll answer the question now. I think the question was about what if the government and the banks collapse? What would happen to all the programs? Well, I have experience not here in the UK, but I can see from my mom and people in Brazil who get their pensions now. The Brazilian currency, I think, has collapsed like 4 or 5 times in the last 60 years. And my dad, when he was working in Brazil, it was like paying the national insurance in the UK. Everyone paid into it. And he paid the maximum for himself and for my mom, even though my mom didn't work, she could have a pension. And now my mom still gets that pension, but the purchasing power of that state pension in Brazil is not as much as it was when my father paid into it, like in the 60s, 70s, and 80s. So I think it sounds bad, like to say, the banks and the government will collapse. You will get something because governments can always print a new currency. But I think the thing to understand is that it's not going to be as valuable. Your purchasing power will decrease a lot if they're not able. And either way, though, if they keep things going and keep able to inflate, it's still not going to pay as much. And I think that's what the UK has been doing ever since World War I. They've just been slowly debasing the currency. We could get to a point, though, where they lose control. What's your view, Clive?
I'd like to just go back to the bit about pensions and paying in that you started out with, because that got me thinking about a big mistake I made, and I'm going to, maybe other people should think about this. When you pay money into a pension fund, in the early years, you're paying money in, it's earning some interest, and the amount you've got in your pension fund goes up and up, and your buying power is going up and up. But there comes a point when you've got so much in your pension fund that although you're paying in and the absolute number's going up, the buying power of that absolute number is going backwards because the inflation is reducing your buying power faster than you can pay in. So if I do the maths, I should have retired 6 or 7 or 8 or 9 years ago, because if I would have retired then, I could have bought more gold or more equities or more houses or more of anything, really, with the money I had back then, which was a lot less than I had when I retired. But realistically speaking, the buying power had gone down a lot faster.
Yeah.
So my advice to anybody is, if you have a large pension fund and you can control how it's invested, which I could not in my case, try and encourage or ask your pension manager to invest it for a way which will keep pace with inflation, at least. Unfortunately, in Switzerland, the rules aren't in my hands. It's in the hands of the government, who dictates that you've got to have a certain percentage in government bonds and a certain percentage in other things. So there was only a certain part which could be exposed to inflation-protected assets.
Yeah, I remember I worked in Switzerland for like 3 years when I started out. And when I left to come to England, they paid me my Swiss pension. I took it out. And I already had, for someone quite young, I had 10,000 francs, I think they gave me. But
well, when I retired, I did exactly the same thing, because I can't see the sense of leaving my money with a pension fund manager who's going to invest it in a very conservative way. And that's not going to keep up with inflation. At least I have a chance. I might suffer very big swings as the world markets, gold price, equities, anything else goes up and down, but at least I'm in tangible assets which will still be there and still standing 10 or 20 years from now.
Yeah, someone said something about quite a few Italians relocated to Brazil around World War II time. And there's Rudy. Well, actually, on my father's side, his grandfather went to Brazil in 1892. So, yeah, but I think probably a lot did go to Brazil after World War II. But I think a lot of the majority of people that are descended from Italians, they went there in the late 1800s, early 1900s. Oh, Clive, I want to show you another chart. And this is just to show people, because earlier I showed a chart of how the pound has done badly against the Swiss franc. But if you look at how the Swiss franc has done against gold since 1960, right? So this is how many grams of gold 1 Swiss franc could buy. Well, it's gone down 91%. So I guess the moral of the story here is that gold is really the ultimate currency or money to have, don't you think?
If you measure it in pounds, it's 99 point something percent.
Yeah.
And if you measure it in US dollars, it's pretty close to 99%.
Yeah, but in Swiss francs is
91.
I mean, it makes a huge difference, those that 8% outperformance over 63 years.
Well, it's that chart you showed right at the beginning where you could get 12 francs for a pound, and now you can only get about 1 franc.
Yeah, I know.
You've got 12 times as much in the Swiss franc as you would have done with pounds.
It's amazing how that works.
There's just an interesting comment to make about Switzerland. The debt to GDP ratio in Switzerland is, compared with all the other countries in the Western world, pretty low. It's only about 40%, whereas we can see the United States is over 100, the United Kingdom's over 100, and so on.
Yeah, let's have a look here. Switzerland, 48%. It says, is that right?
It's something like that, 48%, yes.
Yeah, look at Russia, 19.4% debt to GDP.
Yeah, we mustn't forget they defaulted not too long ago, maybe a few decades ago, when they got rid of all their old debt and their old currency. So that's perhaps why they don't have quite as big a debt as some other countries.
The other country that I find it interesting is Greece, because, Greek interest rates are still very low, the government bonds. And we know that is it 2011, 2012, the Greek 10-year went to 40%. Basically, Greece was bankrupt. And then the ECB and Mario Draghi saved it. But it doesn't take away from the fact that they still have 228% debt to GDP, So for those people who think Greece is safe, just because their rates are like, I don't know, 3 or 4%, think again, because if rates start going up, I think, in my opinion, Greece, I think Italy as well is going to be in trouble again, 172%. And even Portugal, 145, and Spain. I'm surprised their rates are still really low. Have you got a view on that, Clive?
I certainly wouldn't invest in Greek bonds. And if you take my advice, I wouldn't invest in the bonds of any European government. And I speak from personal experience because in about 2015 or thereabouts, maybe it's 2012, I got royally screwed over by the ECB, who forced the Greek government to pass a law, which, because the bonds back then were pari passu, every bondholder had the equal right. But they basically passed a law which said the ECB can decide what they like and everyone else can go jump in a lake. Yeah. So what the ECB decided was that the ECB will get paid 100% on those bonds, and everybody else would get about 10% in 30 bonds with low interest rates and long maturities. When I came to sell them, I actually ended up paying money to sell those 30 bonds after the commission. If I had been treated equally with the ECB, who had then perhaps we'd have got 10 or 20 or 30% payout. And we were expecting a haircut, but to treat one bondholder differently from another it just leaves me cold. I wouldn't, if after the ECB did that, I wouldn't touch anything from Europe at all.
It's not cricket.
No, it's not treating investors equally.
Yeah. Someone asked about Sweden. Yeah, 42%. That's relatively low. One that I was surprised is Ireland, because they had problems in 2011, but they've gotten it down to 63%, which is pretty good, I would say. Clive, the other thing, article I saw today, I think it was published yesterday, is this here, and I think it's a huge contrarian indicator. It says, a milestone moment why economists think the global cycle of rate rises is over. And I'll just skip here to this person here, and I'll highlight it. This is a chief global economist of capital economics. And she said, we have reached a milestone in monetary policy. The global monetary tightening cycle has ended. I think that's just so I think it's going to be proven wrong, because we've had 25 years of very low rates, and now things are going the other way, and you can't expect that to just be a blip, what we've seen in the last 2 years. And that's why I don't think it's ended.
First of all, they haven't got and they probably won't get the inflation rate down to 2%, which means that they've got to have a tight monetary policy for quite some time. Having said that, central banks can put the short-term interest rate wherever they want to. What they can't control as easily, except at great expense, is the longer-term rates. So given the government's borrowing requirements in the United States, I'm referring here to the United States, which is very similar to the UK and the rest of the world, they're going to have to keep borrowing more and more as a percentage of GDP. And that does mean that interest rates on these bonds either have to be very much higher, or the central bank has to step in and buy them off the government. But I don't really think that we're in for a period of going back to these low rates we've seen over the last decade. Most of my life, interest rates were well above 5%, well above. In the UK, more like above 10% a lot of the time. I think we're heading most likely higher than the where have we got at the policy rates at the moment? So ECB's 4.5, UK's 5.25, USA's 5.5. I think all of these rates are heading above 6 in due course.
Yeah, I think so too. I mean, people seem to forget, like you said. I remember when I started out in the business in the late 80s, early 90s, one of the clients did something unusual, because we usually didn't do deposits. We just held bonds, but they did a 3-month euro dollar deposit, and they got over 7% for 3-month money. So people seem to think the last 25 years is the normal, but I think is an aberration. And yeah, maybe the Fed might be able to cut rates back to like 3.5, but that will be it, and then it will have to rise again.
But the longer term rates can't be put back so easily.
No, and they're gonna, so the curve is going to be steeper, right?
Yeah, so we're going to have a steepening yield curve until such time as the Fed does a pivot.
Yeah.
And as I said, we can't get to 2033 on the present plan, at least not the way the Congressional Budget Officers planned it out. And that means at some point the Fed will have to do a pivot if we don't want to have a complete disaster.
You mean a pivot, like they'll stop the QT and start doing QE?
Exactly. They will buy government bonds to stop interest rates from rising too fast or getting completely haywire. And that means that, to the man in the street, that means they will print the money with which they buy the government bonds. And as they print the money, it will create chaos in the market as the minute they do this, there'll be chaos in the market as everybody realizes that tight money is over, and they rush into tangible assets, and that will push up the gold price, it'll push up the silver price, it'll push up equity prices, and over time, it'll help property recover as well.
Yeah, Clive, I just saw someone comment that Barclays is to close UK accounts of all British expats. And it's funny because I saw this article and I read it today. And I thought to myself, apparently there's over 1 million expats abroad. I'm not saying they all have their money with Barclays, but I think this is just another nail in the coffin of the pound that, I'm sure the other banks will follow. So hopefully you don't have an account with Barclays.
I think all UK banks are going to do exactly the same thing. And yes, unfortunately, I do have an account, not with Barclays, but with a UK retail bank. And I'm quite sure they're going to close it. But to be honest, in this day and age where you can have foreign currency accounts wherever you live, it doesn't really matter to me. I'd be quite happy if they closed it.
Yeah, but there's a guy here, this professor, he's saying that he's been away. I think he went to Australia in 1988, and he still does a lot of his banking through Barclays, and it's going to be a problem for him. You see, he collects his pensions from Barclays, book royalties, and he pays direct debits and stuff. So it could be, for him, it will be a problem. But like you said, I agree, with you can do foreign exchange. But I think it's fairly significant they're doing that, and I'm not sure why they're doing this.
The problem with the world we live in is one of all the banks have to disclose everything to every country. So Barclays will be disclosing the information about the account sizes and account balances and interest and everything else to literally every country in the world, as they're required to do so under the Common Reporting Standard. And that must be terribly burdensome for them, because they've got to get it right. So they've got to make sure people are really living where they say they're living. So you could have somebody saying they're living in Dubai when in fact they're living in Turkey, for example. And the penalties on these banks will be quite severe if they're perceived to have not carried out enough due diligence. So I think the reality is a bit like the politicians. They're trying to cut down on their costs by getting away with doing away with things which use up their time in checking. So I do think it's coming for all the banks. They're going to not all banks, but all retail banks. They're going to close down the accounts of foreigners.
Yeah, it's a sad state of affairs, I think, because I'll give you a story. In 1974, I was about 9 or 10. I don't remember the time of the year, but my dad used to travel a lot for business, and he also used to do a lot of sailing. And we went to Australia for a month. And my dad actually opened a bank account in Australia. I remember it was the New South Wales Bank, just for a month. And because I remember it well, because they gave me a little money box. It was like an old metal money box. And and I took it to Brazil when we went back. But and I think my dad kept that account there with a bit of money for years. Eventually, he closed it. But you could open an account. You get to a country. I think we had like a version of an Airbnb. Him and his other friends that were sailing, we rented a house, and there were like 3 families in it, and we were able to buy. He was able to open an account like that. But nowadays, like you said, like in Switzerland, I tried to open an account a few years ago, and they said, "Oh, you don't have a Swiss address. We can't open you an account." But 20, 30 years ago, anyone could open a numbered account, and you just probably had to show your passport.
Well, you obviously you could open an account, but they expect you to put a few million into it.
Yeah.
That's it's called a private banking account. But
Yeah.
if you want to have 10,000 or 100,000, and you're not living in Switzerland, there's no chance.
So if you have a few million, how do you, they don't need you to have an address in Switzerland, or?
No, but they will do very extensive due diligence on the source of your money to make sure you really live where you live, and to make sure you really are who you are.
Okay.
The DD is very, very rigorous.
Yeah. Oh, Clive, someone is asking your take on CBDC. I guess they didn't watch our first interview.
Okay, well, let's have a chat about that. First of all, CBDC is coming whether we like it or not. And I think what this does is present a danger for the public at large, as well as an opportunity for the government to solve their major problem, which is one of excessive indebtedness.
Mm.
When the CBDC arrives, it will be one-to-one convertible with the money in your bank. So the money you have in your bank, £1 will be £1 in the CBDC. It'll be the same thing, and you'll be able to move your money freely, but from one to the other. But at some point, when there is a crisis of some sort, let's say we're all running down to the shops and buying up toilet rolls, and I imagine the crisis will be much worse than that. Maybe there's a food crisis or some other war or whatever it happens to be. At some point in the middle of a crisis, when there's a loss of confidence in the currency or a loss of confidence in the bond market, they can quite simply bottleneck the amount of money you're allowed to move over to the CBDC. And when we get to that point, it'll already be law that you have to use the CBDC for every transaction. You won't be able to use your old dollars. You have to take your old dollars, put them in CBDC, and then do your transaction. When they bottleneck how much you can move, and it won't affect the small guy, but the people with 10,000 in their bank or 5,000 won't be affected. But those who've got 100,000 or a million will find themselves severely affected, because either they'll need to get permission to move the money into the CBDC for certain special circumstances, or they won't be able to do it at all. And what that means is ultimately the old currency that you hold today in your bank account will not have the same value as the CBDC, because you can't spend it. And effectively, that means over time, it'll wither away to nothing, which solves the bank's problem, as well as the government's problem of over indebtedness, because their national debt is denominated in old pounds, and it'll be effectively withering away to nothing in a currency which cannot be used in the economy, because what's being used in the economy will be the CBDC. So my advice to anybody is don't have too much currency in the bank, because you might find that you can't convert it to CBDC. And if you can't convert it to CBDC, you won't be able to spend it.
Yeah, and Clive, someone's asking your Chesney Mabody 96. Do you think CBDC will work over a long period of time with it being restrictive?
I think we've all got very used to using our credit cards and debit cards, which are digital money, but they're not CBDCs. These are liabilities of our bank, as opposed to liabilities of the government. It's not so much the problem of whether the CBDC can last for a long time or the money we've got can last for a long time. It's a question of whether you have confidence in the currency. So a currency crisis or a confidence crisis could have come from nowhere at very short notice. So I can't answer that one other than to say I don't think it'll last. But
what about, someone's asking here, what about bonds? Bonds is the same. Bonds are going to be like...
the bad news is if you own bonds in Apple or whatever, those bonds are denominated in the currency of today, which will not be the currency you're using 10 years from now, you'll be using the
I guess
CBDC.
that will help the corporations as well.
Yeah, because their debt will be denominated in a currency which is going is defunct, is worthless. So they'll be booking profits because of that, and they'll be able to re-leverage and borrow to build factories and hire workforces and so forth. It'll also be great for the man in the street with a mortgage, because his mortgage is denominated in the old currency, and that will be going to nothing. Now, it depends on the country and it depends on the rules, so it's not guaranteed to happen in every country. But typically, when you have a currency reset, and we haven't had a currency reset in the way I'm describing in the past, but we have had failures of the currencies, those who owed money in the old currency end up owing the old currency, which is worth nothing. So they start with a house and a mortgage, and they end up with a house but no mortgage.
Yeah, Hannah's asking, I guess stocks will be priced in the new CBDC as well.
Oh, you'll be just fine with stocks, because the companies still own the workforce, the supply chain, the
but they'll be
goodwill.
quoted in the new currency, right?
Oh, yes. Yeah, absolutely.
Just to show you here, Clive, I bought some Brazilian junk silver. That's like from when Brazil was an empire from the 19th century. They're really nice coins.
Can you show me that one a bit closer?
Yeah, there you go. Hold on. There's the.
Oh, that's a lovely coin.
And then that's Peter II, the emperor. Yeah. So he was emperor until I think 1834 or something till 1889. Brazil became, I think there was more like I don't think the people in Brazil wanted to change to a republic, but there was like a military coup, and the whole royal family had to flee to France. They're still around though, that family. And I've got also, that was 1,000 reais as they called. This is the 2000 one. So that's a bit like a $50. Mm. They're really nice coins.
They are lovely coins.
Yeah, there he is again. So,
well, while we're on the habit of showing coins, can I show you one, Mario, that I bought the other day? It is definitely the most beautiful gold coin that I have ever bought. And this, I'm sorry, it's not in focus.
The Australian one with the
Australian nugget.
Oh, it's,
it's absolutely
the Hello Stranger one.
This one.
That's what it's called. That nugget, Hello Stranger.
This one's called the Australian nugget. It says, doesn't say the.
Oh, okay.
It just says the Australian nugget.
Yeah.
It's a 100 pound coin made of gold. I paid 1,900 Swiss francs for it. Wow. Which is about $200 or 200 francs over the gold price.
Yeah. What about?
But it is an old coin, and it's quite beautiful.
How will gold and silver do when CBDCs come along? What do you think will happen?
First of all, I don't think gold and silver is going to be confiscated. I know some people say that that's a risk, but I don't see that as a risk at all. Secondly, I think people will, after a currency reset, will have a desire to own gold and silver much more than ever before, because once you have a loss of value in the government debt or the currency, people will fear it will happen a second time. So the desire to hold that type of asset is going to be much higher. There'll be far more people wanting to hold it. So gold and silver will do very, very well as, first of all, as the government finances start to deteriorate, and they're going to deteriorate. And secondly, after a reset, when something happens to the currency, whether it's default or dual currency system or exchange controls or wage and price controls or a reset, whatever it happens to be, after that, people will trust the currency a lot less, and there'll be more people wanting to own gold and silver. So I think the prospects for gold and silver are very, very good at the moment. And the risk, yes, it could go down with higher interest rates, but not necessarily. It's not written in stone that gold has to go down. A lot depends on people's expectations of what the alternative is. And the alternative is going to fiat currency, which is quite unsound at the moment.
Well, I was looking at the Japanese 10-year yield is gone from like 0 or even negative to almost 1% now, and gold in Japanese yen has gone the same way. And in the US as well, we've gone from 0 to 5%, and gold is still near 2,000. So, well,
and you'll find the gold price in Turkey and Argentina is at all-time records as well.
I'll show you something special here, Clive, and to the viewers as well.
That's a gold ingot.
Yeah, it's a Rothschild 50-gram gold bar. Don't know if you can see it. There you go.
Oh, okay, nice.
It's really rare because there you go. And I bought this about 15 years ago for about 400 pounds. Now it's a lot more. But the thing is, the Rothschilds, they used to own the mint up until 1968. The Royal Mint Refinery was run by them, and then they sold it to the government. So they stopped minting these. This is like from pre-1969. So it's also more of a collector's bullion bar, which is
back in the late 60s, there was a huge scam going on in the UK where you could come into the UK with your, or you could, in the international market, you could buy pounds on the international market, get far more pounds internationally outside the UK than you could in the UK. You could smuggle those pounds into the UK, buy some gold at the London official price, smuggle that gold out of the UK and sell it for the official price outside the, but now the official price would be in Swiss francs or dollars, and you could change your money back into the currency you started with and end up with a lot more. And the government was trying to clamp down on it, and they brought in all kinds of rules. Well, obviously it was completely illegal to do it anyway. Yeah. But effectively you had two exchange rates for the pound. It was called the dollar premium.
Yeah. Oh, one more story. When I was working in the city, one of my clients was a guy at the Citibank Treasury, and we went for lunch, and it was late 90s or early 2000s, just when you started having internet banking, and I had an account with Citibank, my private account, and I had quite a bit of cash in the savings, and I had a dollar account, and I noticed like when there were sharp movements in the cable rate that Citibank wouldn't update it until the next day. So I would be able to like take advantage of that, and then the next day close it out and make a profit with no risk. And stupidly, I told them about it. And then a few months later, they kind of updated their system. But yeah, it was like arbitrage because they weren't updating their online things.
You know, people are always figuring out ways to make money out of the banks free of charge. Yeah. I remember some years ago when interest rates on Swiss francs had gone negative, some clients were pretty smart. They figured out they could borrow the Swiss francs from the bank at zero, which the bank was quite happy to lend them at zero, given that the rate was really negative. And then they could do a forward foreign exchange transaction to sell those Swiss francs on a forward basis, effectively ending up with more money than they started with in dollars.
Yeah. Well, I'm going to show something that people should have if they're into having gold and silver coins. It's just buy a little scale.
And make sure if you get one of those scales that it goes down to not 1/10 of a gram, but 1/100th of a gram.
Yeah, I mean, I've got another bigger scale, but this is pretty good. And it's a good way of, seeing if the coin is fake or not. But I would say the longer you deal with gold and silver with the coins, the more you know right away if they're fake or not. I went out with someone a few weeks ago, and he showed me this coin. It was it looked like a gold coin, and it was from the Vatican. And I said, well, that's not gold, because the moment I held it, I knew it wasn't gold. And he said, you're right, it's not. So
you know the safest way to know if something is gold or not, I'm talking about a coin or a bar, is what's called the specific gravity test. You can do that at home. It's completely free of charge. All you need is a scale like the one you just showed and a bit of toothpick wire, what used to
dental floss.
Dental floss, a bit of dental floss, a glass of water, and a scale like you've got. People can look it up on the internet how to do it, but it's absolutely fail-proof to tell you if the specific gravity of the coin is exactly where it should be. So if the coin happens to be filled with another metal, or
Yeah.
it's the wrong size. Even if, or it's the right weight but the wrong size. The
Mhm.
specific gravity test will tell you that it's not real.
Yeah, I've also got here, it's a magnet. So if you take the Brazilian silver coin, it doesn't stick. So gold and silver should not stick to the magnet.
And actually, if you put a coin on a magnet, a large magnet, and slide it at a 45-degree angle,
Yeah.
silver will slide slowly.
Yeah.
Other non-magnetic metals like cupronickel, pound coins, whatever, will slide fast. So silver always slides much slower on a magnet
Yeah.
than other metals which are non-magnetic.
All right. I think, yeah. Anything else, Clive, you wanted to tell people?
Well, obviously, we've had only one rate rise in the last week or two, which was from the ECB. The UK and the USA are on hold. I think that's temporary. So, from my perspective, I think that article you showed of rate rises over. I don't think that's the case. I think they're waiting to see what happens. So yeah, I think it's we're in for higher rates, and especially on the bonds. In terms of the asset allocation chart I showed you, you saw there was a lot of assets on it. And the reason for that is I don't know what's going to happen. I can't see the future, definitely. I have some ideas, but I could be wildly wrong. So I never put 100% of my money into anything. I like to have a lot of fingers in a lot of pies. And I know that some of those will work out and some of them won't.
Yeah, no, that's good. And yeah, so nice talking to you again, Clive. Thank you for everyone that showed up on the live stream. And hopefully, let me know if you want to talk about something that you think is important, and we'll hook up again soon.
Thank you, Mario, and have a lovely evening.
You too.
And hello to all your listeners. Anyone who wants to follow me, by the way, you can follow me on LinkedIn.
Oh yeah, just check him out on LinkedIn. You write a lot of stuff there, don't you, Clive?
Yeah. One thing which I'd encourage everybody to have a look at is the story I wrote a week or two ago about a man who threw himself into a vat of boiling beer because he went short the market when the one stock he chose to go short of went to the moon.
Oh yeah, I remember that. That was back in the late 1800s, wasn't it?
Yeah, it actually happened in 1901, but when you read the story, it's one of the most amazing stock market stories that has ever been told.
Oh, was it the Union Pacific Railroad?
That's right. Yeah, it was a story about a railway magnate who wanted to control one of the railway lines, and well, there was two of them, and they ended up owning 120% of the shares because the short sellers had sold shares they didn't possess, and there was a squeeze, and the share price went from $30 to $1,000. At the time, the stock market was crashing.
Yeah, and there was a lot of stock market manipulation even before there was a central bank in the US. I think it was 1869, the term Black Friday came from they manipulated the price of gold higher. Gold, and the guy called Gold, Gould, and I think they had to close the stock market because they drove gold up to $180 an ounce back in 1869. Have you heard of that one? Yeah.
I hadn't heard of that one, but I'm going to have to look it up.
All right. So thank you everyone again, and enjoy your week and the rest of your weekend.